Hello, everybody. Thank you so much for tuning in. Whether you're joining me live or you are catching the recording of this, I really appreciate you coming. Tonight, I am going to talk about first-time homebuyers. This is really the ultimate guide for first-time homebuyers, and really, this is going to be some great information for those of you out there who maybe bought a house a long time ago and just kind of forgot everything that was involved in buying the house, or maybe you had no clue what you were doing and you just want to understand it better. So I'm going to go into some detail about just some first time home buyer stuff. But before I get started, I just want to talk a little bit about me. My name is Erica Belay. I am a mortgage loan officer for Best Life Mortgage Corporation. So we are a brokerage. I currently live in Kyle, Texas. And I grew up in New Braunfels, was born and raised in New Braunfels. So I've been in the Central Texas area for a long time. I do most of my business between San Antonio and Austin, but really I can do loans anywhere in the great state of Texas. And so I just would love to help as many people achieve their dream of home ownership. I was a former math teacher and high school volleyball coach. And I've been a real estate investor. So I'm just really, really passionate about real estate. And my real estate investing is what ultimately led me into the mortgage business, because the math teacher in me, I love doing the money and the numbers. The teacher in me just like loves to help people. And then the real estate investor just knows that it's such a great investing in real estate is just such a great investment. Whether it's a primary residence or rental properties, you're investing in your wealth rather than throwing away money on rent. And so I just want to help as many people do that. So without further ado, let's jump into the ultimate first time home buyer guide. So tonight I'm going to cover a lot of things tonight. So I'm going to go over just the basics of a home loan. What is a mortgage? What are the steps of the loan? What does your loan officer do, and how does your loan officer get paid? What is my role as a loan officer? And then I'm going to talk a little bit about financial preparedness, what it means to be financially prepared to purchase a home. And I'm going to kind of use a house analogy there with the foundation, walls, roof, and just your lifestyle. And then I'm going to jump into some of the different home loan programs that are available. I did a live stream on Tuesday, just a couple days ago, covering most of these home loan programs. So I'm going to kind of go through those pretty quickly tonight. And if you want a little bit more detail, you can catch that the other live stream. It's available on Facebook, LinkedIn, and on my YouTube page. So anyway, let's talk about the basics of the home loan. I want to be able to answer the most common question, but probably some of the most important questions about purchasing a house are with a lender, financing. So what is a mortgage? How do I get a mortgage? How do I qualify for a mortgage? There's some of you out there that might be paying all cash for a home, but I would say that the majority of people who are buying a home need to get a mortgage. So what is that mortgage? A mortgage is an agreement between the home buyer or the homeowner and a lender. That agreement allows the home buyer or the homeowner to borrow money from the lender for the purchase of either purchasing or refinancing your real estate property. But this agreement also allows the lender the right to take the property if there is an extended failure of repayment. So what makes up the monthly payment of the mortgage, and when is it paid? So the monthly mortgage payment is made up of the principal. So that is the initial loan amount that you borrowed, the principal, the interest. So what interest that you are paying each month, your property taxes, and then your homeowner's insurance. So those things are called PITI, principal, interest, taxes, and insurance. Some people will call it PITI, or PITI. So some acronyms that when you're a first-time home buyer, you might get a bunch of acronyms thrown out at you and you're like, I have no idea what that means. So make sure that if you are talking to a loan officer or a real estate agent or just anybody about the process, that if there's something you don't understand, you need to just stop somebody and ask. Because when those of us who have been in the mortgage industry or in real estate, we throw around these terms, and if you're a first time home buyer, you might not understand it. So PITI is principal, interest, taxes, and insurance. And so that'll also include if you have to pay mortgage insurance. And so depending on the amount of down payment you have or what type of loan you have, you might have to pay additional mortgage insurance. And then this also will include homeowners association fees. So if you are buying a house in a community that has a homeowners association, HOA, then that's also counted in your PITI, principal, interest, taxes, and insurance. So so that's what a mortgage is, and you're going to be paying your monthly PITI. Usually it's due around the first of the month. And so let's now jump into the steps, the home loan steps demystified. So you're sitting around, you're renting, you might be renting a house, or you might be renting an apartment, or you might be living at home, or, living with relatives, but you decide, hey, I want to buy a home. Well, the first step is to figure out how much home can you afford. So you can't go start shopping for a home, and you don't want to go talk to a real estate agent and be like, oh, I want to buy a $500,000 home if you have not already been pre-approved for that home. So the first step number one there, is you're going to submit a home loan application. And that means that you're going to submit an application that's going to show your work history, your address history, your assets. That's how much money you have in the bank, savings, investments, anything like that. And then as a loan officer, your loan officer is going to pull your credit report. And so basically, as a loan officer, I'm going to just do a deep dive into your financial situation. And I'm going to see, how much house you can afford based on your income, based on your credit, based on your debts, based on how much money that you have available to put down. So that's step number one. So, and then I'm going to search. So as a broker, I have access to several different lenders. Now, if you just walk into your local bank and try to get pre-approved with your local bank, that's fine. They're going to offer one, maybe two products for you. Here's a reason why I think brokers are better. Brokers like me, I have access to a bunch of different lenders. So if you're going in all around to different banks, you're doing that shopping. You're going from one bank to the next, one lender to the next, and you're shopping for the best loan. Well, me as a mortgage broker, I don't work for the lenders. I don't work for the bank. I work for my client. And so I will do that shopping for the home loan for you. So I'll find the best loan program, and I will give my clients a pre-approval based on how much I have verified that they can afford. And then that's when the fun stuff happens, where you actually get to go with your realtor and start shopping for a house. So that's the fun stuff, right? So this market's been crazy. It's definitely right now at this time a seller's market. Inventory's low. So you definitely, as a first-time home buyer, want to make sure that you are working with a real estate agent that has a team with a lender. So I work as a team with my realtor partners so that we make sure that we've got everything ready to go and that you can submit an offer that's going to be competitive in this, multiple offer type situations that we're in with inventory and with it being a seller's market. So once you submit an offer and that offer gets accepted, that's when you'll have a sales contract. So you and your realtor will work up the sales contract with the seller. And then that sales contract comes to me to your lender. And, at that point, I get everything together. Like we recheck documents. We make sure that, we check what are the taxes on this property that you are, that you're putting an offer in for. And so I run all this, and then the next step, I submit it. So I pick whichever lender we're going to go with, and I submit this loan to underwriting. So that's step 4. I submit the loan to underwriting, and then underwriting comes back and we get a conditional approval from underwriting. Conditional approvals usually have a list of additional documents and additional things that will need to be verified by the underwriter so that we can get this loan closed. So your loan file is then submitted to processing. This is when we will order your homeowner's insurance, we'll order title work. So we'll go to the title company, get some title work, we'll order an appraisal. Um, and then we'll also work on, between me and my processor, my processing team, we'll work on getting all the conditions that we got from initial underwriting, get all of those conditions submitted. Somewhere in this process, you will also talk to your lender about locking your interest rates. Sometimes we lock interest rates before we submit it to underwriting. Sometimes we wait and we kind of just watch and see what the market's doing. But at some point, you're going to want to lock your interest rate. So until your interest rate is locked, the rate that's being quoted to you could go up, could go down, depending on what's going on with the market. But once you lock that interest rate will be locked for a set period of time. So you could lock your interest rate for 15 days, for 30 days, for 45 days, 60 days. And then I even have some different programs where you could lock while you shop. So right now we're in a rising rate environment. That means interest rates are kind of steadily going up. So maybe you want to lock your interest rate in while you're shopping for a house. So that's an option too, but that's definitely a conversation that you want to have with your loan officer. So if I'm helping you, I'm going to have that conversation with you about when's a good time to lock the interest rate. But ultimately, as the borrower, as the buyer, locking the interest rate is up to you, because you could lock it and then rates could go down. So that's, once you lock it, you're locked in at that rate, whether the rates go up or down. Okay. So after we've submitted all the conditions to underwriting, we've locked the interest rate, underwriters, and a lot of this stuff is happening in the background. So you as the home buyer, you just need to be prepared if your loan officer or your processor calls you up for like needing any additional documents. You just need to try to get those documents in as quickly as possible. And then a lot of this other stuff happens in the background. So then finally, the final step is the CTC. So that means the clear to close. So the underwriting will look at everything, and then we would receive the final approval and we can schedule that closing date. So basically that's it, like 7 steps. Those steps could happen over the course of, depending on, there's a lot of different things that go into how long this takes. The beginning part of shopping, pre-approval and shopping, could take a long time depending on how quickly your offer gets accepted. But once we're in underwriting, we want to try to get those loans closed and get that clear to close as soon as possible. The average time is 30 to 45 days. And a lot of it depends on how quickly we can get an appraisal back. But basically, those are the steps for the home loan and the home buying process. Now, how does your loan officer get paid? What is your role? Now, this is, as a brokerage, as a loan officer for a brokerage, I get paid on 2 different ways, either lender paid or borrower paid. So really, I work for my borrower. And if the lender could pay me on the back end, but when that happens, basically my payment is built into your interest rate. And so you don't notice my payment because it's built in the interest rate. You're paying basically for it monthly in what your rate is. If we choose to go borrower paid for the loan officer, then that basically just means that you pay your loan officer's compensation as part of the closing costs. And typically when it's borrower paid, your interest rates are lower, but you have to come up with more money up front. When it's lender paid, you're going to have slightly higher interest rates, but you're not going to have to come up with as much money in closing costs. And so what is it that your loan officer is doing? Basically, we're trying to find the best loan for you. We're trying to make sure that we're being compliant. Every lender has different overlays. So that's kind of like guidelines that lender has. There's also just the different loan programs and their guidelines. So it's our job to listen and figure out what your needs are, figure out what your financial situation is, figure out what you can afford, and then make sure that we're gathering everything and getting all the documents that need to be so that we are compliant with the different loan programs. So that's ultimately what your lender does. And some situations can be fairly simple and straightforward. And every buyer has different financial situation. And so sometimes that can get a little bit more complicated. And your lender might have to be really creative in helping you figure out ways to get pre-approved and to get you the loan that you need. So let's talk about being financially prepared to purchase a home. Now, like I said before, I'm going to do I'm going to just kind of use a house analogy, right? So I'm going to talk about the foundation, the walls, the roof, all the things like a house that'll the things that you need as a buyer to be financially prepared to buy a home. So the first thing is the foundation. That is your income and your work history. Most lenders want you to have a job, want you to have some income, want you to have some employment history. So it's an important factor that dictates the purchase price and the monthly payment that you're going to be able to afford. And to go like at a deeper level, lenders typically want a 2-year work history. Now, that does not necessarily mean that you have to have 2 years in the same job. If you've changed jobs because you've got an increase in pay or because you've moved or for various different reasons, um, as long as you have 2 years of solid history of employment, it looks pretty good. If you have 2 years of work history, but you're constantly jumping around from job to job and you have gaps in employment, that's not going to look good to a lender. So a lender really wants to have that stable income that's increasing. So if you are changing jobs, they want to see that that's increasing. If you're self-employed, they want to see that your income is trending upward. And so those are some of the things that we look at. They want to see that you are working full time. So that's at least 30. That's like 30, at least 32 hours a week is considered full time. And then there are instances when you don't have to have a 2-year work history. For instance, if you've been in the military, your time in the military can count as employment history. If you are a college student that's about to graduate, as long as you're getting a job that's in the field that you studied, your time at university or at a trade school even can count as your employment history because you're getting the education to be prepared for that employment. And like I said before, they want to have minimal gaps in employment. And sometimes they're going to look at different things like, are you paid hourly? Are you paid salary? Are you paid overtime? We're not always going to get to count the overtime. So if you have consistent overtime that we get 2 years history on, we can count it. But if your overtime is kind of all over the place and you don't have a consistent 2-year history, we might not be able to count the overtime. So there's a lot of different factors there in this foundation of income and work history. Okay, moving on to the next part of my analogy. So the walls, okay, this is your spending and your saving habits. So your spending and your saving habits will make up the walls of this financial home we're building, right? So most home loan options require that home buyers have at least 3 to 5% of the home's purchase price as a down payment. And then plus you need to have the cost of the lender's services that could vary anywhere from 2 to 5%. So I have a lot of first-time home buyers that come to me and I ask them, how much money do you have saved for down payment and closing costs? And they don't even realize that there's closing costs. So you've got down payment, which is a minimum of 3 to 5%, but then you also need to have additional money for closing costs, which is another 2 to 5% of the loan amount. So let's put this into context. You want to buy a home that is worth $250,000. So the purchase price is $250,000. You're going to put a 3% down payment. That's $7,500. So you need $7,500 for the down payment. And then for the closing costs, if you put 7,500 down, that leaves a loan amount of 242,500. So we're going to basically, the loan amount is subtracting, the down payment from the purchase price, right? So another 2 to 5%, you're looking at an additional $4,000 to $5,000 in closing costs. So to purchase a home for $250,000 with a 3% down payment, you need that 7,500 in down payment plus the additional 4 to 5,000 in closing costs. So you're looking at $12 to $14,000 that you're going to need for down payment and closing. Now, we have some different programs that might help with down payment assistance, but more lenders want to know that the home buyer has some skin in the game. And so you just want to make sure that also, if you're saving money for this down payment and for these closing costs, that money needs to be seasoned. So seasoned is another term that first-time homebuyers might not understand. So if you are working and you have a bunch of cash sitting in a box under your bed, that cash is not seasoned. Seasoned money has been sitting in your bank account for 60 days. So you don't want to make, in the home buying process, you don't want to make any huge cash deposits and then say, hey, I'm going to go buy a home. That money needs to be sitting in the account for at least 60 days because lenders are going to look for the last 2 months of assets, and huge deposits have to be sourced. So if you can source the deposit, then it's fine. But if we can't source where that huge deposit came from, then we can't count it. We cannot use it. And this is I get a lot of people that question this. Why is that? But it really is just to avoid things such as mortgage fraud, to avoid illegal activity that might be happening, and it is to protect the lender, to make sure that they're verifying that you are financially prepared. Okay, so we've talked about the foundation, which is our income. And then the walls is our spending and saving. So now let's talk about the roof. This is our credit score and our credit history. So we're building upon your income, your work history, your spending habits. Now your credit score and your credit history, that's going to determine, your credit score is going to determine your interest rate a lot. So a lot of lenders have minimum credit score requirements. Your credit score, so not only will your credit score affect whether you can even be approved for the loan, your credit score will also determine what your interest rates are for that loan. So it's really important to build a good credit history. And so we're going to look at a minimum credit score of 580 to 640, but really below 600 is really tough. And I would recommend that you probably need to do some credit repair and possibly hire a credit repair specialist. And I have some great credit repair specialists that I refer my clients to. If I can help coach my clients through some credit repair stuff, I'll do that myself free of charge. But there are some things that are just better done with a credit repair specialist. But you really want to try to get above 640 on your credit score. And then also, even with like down payment assistance programs, if you're looking for a little bit of down payment assistance, you definitely have to have a 620 to a 640 or higher. And then this also in your credit, when we pull your credit report, that's also telling us what your debts are. So when we qualify you for a home, we are looking at your debts to your income. So if you have a really high income, but you also have really high car payments, really high credit card balances, anything that you're borrowing money for, we look at that as your debt and we calculate what's called a debt to income ratio. So that's a DTI. So all of this is factored in when we're qualifying you. So if you are thinking about becoming a first-time home buyer, these are some things that you want to check. What is my credit? What are my debts? Can I pay down some of these debts to get my debt to income ratio down? And when we look at debt to income ratio, we look at your monthly minimum payment. So if you have credit card debt of like $5,000, we're not looking at the $5,000. We're looking at what does that credit card company make you pay monthly as a minimum, and that'll be counted as your monthly debt. We look at your monthly income. If you have student loan payments, what is your monthly student loan payment? So all of that is factored in to your debt to income ratio. And then the next thing is just your lifestyle. Like, you know, I might be able to qualify you for a really high loan amount based on your debts and your income, but maybe that doesn't fit in. Maybe that high loan amount and those high payments might not fit in with what you feel comfortable spending. So the other part, as a loan officer, is I'm going to ask you questions, and I'm going to say, hey, you're approved for this much. This is what your approximate monthly payments are going to be. Your monthly PITI. Is that something you feel comfortable with? Is that something you can afford? Do you go out to eat all the time? And do you like to travel a lot? And do you like to do a lot of other things that you don't want to be spending quite that much on your mortgage? So those are things we want to take into consideration. It's not just what you can be approved for, but also what you feel comfortable paying within the lifestyle that you want to be living. So that's basically the gist of the financial preparedness. So I'm gonna talk about some of the different loan programs. I'm not gonna go really deep into all of these programs today because I did do just a couple days ago. I did basically this presentation about a lot of the different home loan programs, and so you can go to my YouTube channel or check out my Facebook stream or LinkedIn and see my past ones. But I'm just going to briefly go over these. The conventional loan is probably the most traditional loan program. The conventional loan is its guidelines are governed by Fannie Mae, Freddie Mac, and so there are some conventional loan guidelines that are pretty strict. They have pretty strict credit guidelines. There's pretty strict debt to income ratio requirements. You can get a conventional loan for as low as 3% down. So we have first time homebuyer programs that are conventional loan programs that you can put as low as 3% down. But anytime you put a down payment that's lower than 20%, you will be paying additional in monthly mortgage insurance. And so if you can put more down payment, I would recommend it because then you're avoiding that monthly mortgage insurance. So that's the conventional loan. It's probably the most typical loan program, and it has pretty good interest rates. Now, a zero down payment loan is the USDA loan. Now, this is a loan program that is for rural areas. So it's for rural communities, and there is an income restriction for USDA, and that income restriction is based on the county and based on the median income for that area. So if you are wanting to purchase in a rural area and your income is within those county limits, then a USDA loan might be a great loan for you. It's a zero down payment. You do have to come up with closing costs, but it's a great program. There are some other guidelines with USDA that we'd have to go into. Like there's different things, like you can't have a swimming pool, and the home has to be modest for the size for the area. There's some different things like that. But if the USDA loan is something you're interested in, talk to me, talk to your loan officer, and see if that is an option for you. Okay, FHA. FHA is probably one of the most commonly used home programs for first-time home buyers, although it's not just for first-time home buyers. You can use an FHA loan if you're not a first-time home buyer. But FHA is a little bit more forgiving of credit issues than a conventional. So if you've got some credit history issues, and slightly lower credit scores, some things like that, FHA is going to be a little bit more forgiving, and it is going to get you probably a lower interest rate than a conventional loan. The FHA loan does have upfront mortgage insurance and monthly mortgage insurance. So you keep in mind that even though the interest rate might be a little bit lower for an FHA loan than a conventional loan, you are going to have higher, probably higher mortgage insurance payments for an FHA loan. The other thing is with a conventional loan, that mortgage insurance goes away after once you get 80% equity. So once you've paid down your mortgage, 20% down on your mortgage, then that mortgage insurance goes away. FHA mortgage insurance is there for the life of the loan. There are some exceptions to this, like if you put a bigger down payment, but if you can come up with a bigger down payment than 3.5%, FHA down payment is 3.5%. Can't remember if I said that. But if you can come up with a bigger down payment, then you might be able to get the mortgage insurance removed after 10 years. I can't remember exactly what it is. But that being said, FHA is a great loan program for first-time home buyers to get you into your home. I would recommend that typically we don't stay in these FHA loans for very long. We eventually refinance you out of an FHA loan into a conventional loan so that we can avoid paying that mortgage insurance for the life of the loan. Okay, the next loan program I'm going to talk about is the VA loan. This is for veterans. It is a program established by the Department of Veteran Affairs. It allows veteran service members and in some cases surviving spouses to purchase or refinance a home with no down payment. So it's a great way to say thank you to our veterans. And the beauty also of the VA loan is there is no mortgage insurance. So FHA, USDA, and conventional all have mortgage insurance. VA loan, no mortgage insurance and no down payment. You do have to come up with closing costs. And a lot of times in the past, you could get seller concessions to cover closing costs. Right now, we're in a seller's market. So it's a lot harder to get those seller concessions to cover closing costs, but there are some things that the seller will be required to pay on a VA loan. It's like termite inspection, real estate commissions, and some things like that. The VA loan used to have a bad rap because appraisals used a long time, but now the appraisals are just as fast as they are for conventional loans. And pretty much the interest rates on a VA loan are going to beat out a conventional loan anytime. So if you are a veteran and you can qualify for a VA loan, like that is the best way to go. And there is the lowest number of default on a VA loan than any other loan program. So VA loan is really a great loan program for our veterans. And if you qualify, that's definitely the way to go. Now, I just talked about conventional, FHA, VA, USDA. Those are probably the four most common loan programs. But what if you can't qualify for FHA, VA, USDA because of certain different scenarios? I do have some alternative loan programs. One of them, this one is designed specifically for self-employed business owner loan programs. So for those of you out there who are self-employed business owners, chances are you write a whole lot off on your income taxes. Well, if you're self-employed, we have to use more or less if you're a sole proprietor, we use line 31 of the Schedule C. And if you write off a whole bunch of stuff on your income taxes, your income on those tax returns is probably pretty low and probably isn't going to qualify you for the house that you think you can afford. So if that's the case, we've got these additional programs, these bank statement programs, 1099 programs. So these programs are great for self-employed borrowers that we just look at your bank statements or just your 1099s and qualify you based on that, not your tax returns. Now, these are not loans that are governed by Fannie Mae, Freddie Mac. And so they're private lenders. There's different stipulations. So these typically come with higher interest rates. They typically come with higher down payment requirements, and they're going to come with higher credit score requirements, but they are a means to get those of you self-employed borrowers into a home so that you are investing in something that's building your wealth, right? Not wasting money on rent. I also have some investor loan programs. These are called DSCR, debt service coverage ratio loans. So these are really cool for my real estate investors out there who are wanting to buy rental properties. And maybe you don't have like the stable the stable employment history or the stable job, but we can qualify you with a credit score, a down payment. So if you have the money for the down payment, you have good credit, we basically do a rental appraisal on the property. And if the rent that can come in for that property is higher than the mortgage, then it qualifies. So these are great programs for real estate investors. I would say if you are a real estate investor, you always want to look at conventional loans first because typically your interest rates are going to be lower than these investor loan programs. But again, these are great products to purchase income producing assets. I also have some specialty loans, some construction loans, some land loans, some renovation loans. So I've got a few different products here. For construction, I have this great one-time close program where normally if you're going to build a house, and I'm not talking about houses in subdivisions with with like your DR Hortons or KB Homes. Those you would just purchase with a conventional FHA loan, VA loan. But if you maybe are buying land and you're doing you want to do a custom build, typically when you're doing that, you have one loan for the land, and then you have a construction loan, and then you would refinance into a permanent loan. Well, that is down payment and closing costs for the land. That's closing costs for the construction. That's closing costs for the refinance into permanent. What I have is this really great one-time close program where you get all of that, the land, the construction, and the permanent financing with one closing. So this is a really, really great program. If you already have land or if you are trying to purchase land, this is something that we might want to look into for you. Land loans themselves are hard to come by. And so land loans typically come with a higher interest rate, bigger down payment requirements. It's harder to find lenders that will lend on land only. But I do have a land only lender. So if that's something you're looking into, I can help you with that. The last loan program I'm going to talk about tonight is just the jumbo loan. So the jumbo loan is the loan that exceeds the conventional conforming loan limit, which I think is like 647, 200, something like that. It's about $647,000 loan is the maximum for conventional. That maximum is higher in high cost areas. But basically, if your loan amount is over that conforming loan limit, then we're talking about a jumbo loan. And jumbo loans just have a different set of requirements. There's typically a minimum down payment of 10 to 25%. Your interest rates are going to be a little bit higher. They don't typically have mortgage insurance on a jumbo loan, but lenders are going to look for assets. They might look for reserves, meaning after you make your down payment, do you still have some money available to make those jumbo loan payments? So I've got several different lenders that do jumbo loans as well. Oh, and I almost forgot. Jumbo loans aren't the last thing I'm talking about. The last thing I'm talking about is the down payment assistance programs. I mentioned these before too. Down payment assistance programs come in two forms. It's either a second mortgage, like a second lien, where you basically take out a second loan for your down payment. And sometimes these loans could have an interest rate. Sometimes they don't. Sometimes they are a loan that goes away after X amount of consecutive on-time payments. And then down payment assistance programs can also be grants, a grant that doesn't have to be paid back. Typically with a down payment assistance program, again, it's a trade-off. You're getting some down payment assistance, so you're probably going to have higher interest rates. So that means that your monthly payments are going to be a little bit higher, but you're getting that down payment assistance to get you into the home. So these are some programs that if you are needing that little bit of extra down payment assistance to get you into the home, we can look into those for you. And I'd be happy to help and see if it's better. Like, is this a good deal for you, or can we just save a month or two more and then be mortgage ready? So there's a lot of different scenarios that as a loan officer, I want to be able to help you with and help you figure out the right thing to do that you're going to be the most comfortable with. So that pretty much covers it. I know I ran through those loan programs pretty quickly. I pretty much, like I said, did that same presentation with a little bit more depth a couple days ago. So if you are interested in hearing about those with a little bit more depth, catch my other one, my other live stream, or just call me and let's talk about it. Let's look into it. I'm happy to be a resource for you. As I've said before, as a loan officer, I would love to help anybody out there, first time home buyers. If you're buying another home, I'd love to help you. But even if you're not working with me, you want to just make sure that you build a relationship with your loan officer, that it's somebody that you feel like you can trust, that you feel comfortable asking questions, that's listening to all of your needs and really understands your situation. Um, so we want to get all the details. We want to really understand and really just lead you, help lead you to make the right financial decision that's going to be good for you. You don't want to get into a house and then realize, oh my gosh, I really can't afford these payments, and end up being in a situation where you can't make your payments. So that's where you want to work with your loan officer and really make sure, A, can you really afford it? Um, B, does it fit into your lifestyle? C, is this the best, absolute best program that's going to meet my needs? And so as your loan officer, that's what I want to do for you. And I'm just going to talk really quickly about my company, Best Life Mortgage. Like I said, we are a brokerage. And so that means I have access to a bunch of different lenders. A lot of people typically think about going to their bank, going to the local bank or credit union, but really, as a broker, I can really help you shop for the products that you need and really get you that best price, best interest rate, best program that's going to meet your needs. And so our mission at Best Life Mortgage is just to help you achieve your best life. That's why we're called Best Life Mortgage. We do this in 3 ways. We want to provide first-class experience to both my clients, my referral partners, because we want you to be our clients for life. Um, and we want you to refer your friends and family to us. So I want to offer that kind of service to you. I want to help you be growth minded. Since I've joined Best Life Mortgage, I've really improved on my mindset. I'm on this kind of spiritual journey, emotional health journey. I've lost weight. I've established my magic morning routine, and just some things that just are leading me to lead my best life for myself, for my family, for my clients. And so we want that for all of our partners. And then the other thing, one of the things that I am the most proud of is that we are a tithing company. That means that we give 10% of our corporate profits. We partner with a company called Destiny Rescue, which liberates kids from the bondage of human trafficking. So for some of you out there, that might be really near and dear to your heart. But um, Destiny Rescue is just such a great organization that does some covert operations to go undercover and save kids that have been the victims of sexual slavery and human trafficking. They get them out, they rescue them from these terrible situations, provide counseling, provide training. So every 7 loans that we close at Best Life Mortgage will liberate another child. So we'd love for you to be a part of that mission. And so if I can help you, with any of your home loan needs by doing a loan with us, you are also paying it forward and helping other people. So let me put my contact info up there. You can reach me at 210-279-4392. You can email me, Erica Belay at bestlifemortgage.com. Or feel free to just shoot me a direct message or make a comment in the chat. If I can help you in any way, I would love to be able to help you. Have a really great evening. I hope that you guys, that more of you out there, that this helped clarify some stuff. If there's any questions you have, please reach out. Have a good evening.